All right. Uh, so pretty fucking flat on the day, honestly, but still flat on the day, which matters, I guess. Realized vol crush, uninteresting news. None of the data was really important, and so everyone just sold all the volatility all day. Bulls got squeezed out a little bit in the morning, and they got squeezed out a little bit in the afternoon, but managed to recover the majority of their short put positioning, and then most of the short calls also were able to stay out of the money. So fucking fuck all for the day. Boring as shit. Um, Yields up on the 2 and the 5. Probably a little bit of sell off in preparation for hedging tomorrow's PCE and Michigan consumer prints. Tomorrow's definitely by far the most important day to day. But remember, we're getting the same exact shit tomorrow if those prints aren't, wildly bad or really fucking good. Because options for tomorrow are quite expensive. Correlation coming down throughout the entirety of the day. So we're seeing a little bit of a pushback into dispersion as confidence builds with more data released. Commodities flat for like their fourth day in a row. Gold up a little, silver finally coming down a tiny bit. Oil pushing towards $60 a barrel again, and agricultural commodities are pretty flat too. Move, not interesting. Leverage on the carry trade getting real fucking close to the all-time high from back in January. We're at a 9.36 on the top end right now, but the short end's starting to pull back a little bit. Forward yield on volatility still staying above -10, and the 10-2 kind of flattening out after turning around the other day. Skew up today, but that didn't appear to fucking matter much. It's a little bit of a bounce back in breadth yesterday. About 60% of the S&P above its 200-day moving average. Starting to see tech move a little more yesterday, but underperformed today with Russell and probably like RSP. Actually, RSP didn't do that well today either. Mostly just Russell. Yeah, that's kind of shit. So breadth narrowing. Correlation between VX cash VIX still rising despite the decline in overall volatility. So they're not successfully shorting the underlying demand, which means that if anything snaps, somebody's going to lose a lot of fucking money. Chances of a rate cut for June and March both fell a little bit today. And the 10-2-year spread up about 35 basis points. So for IOR back under control, still 5-point spread on the interest rate on reserves, but back below the standing repo facilities. So a little less liquidity seeking. That's reverting really quickly into tomorrow's print. But if tomorrow's print moves the wrong way and endangers any over leveraged positions, we could see demand for cash spike again. If we don't, I expect demand for cash will rise going into the FOMC meeting. Some of this aided yesterday by some treasury buyback activity. I think about $12 billion worth. Probably help make the front end a little bit more liquid. Leverage dropped a little bit today, but bounced back into close. I think kind of interesting that we're seeing leverage fall off simultaneously with rising prices. I would imagine that's telling us that volume on this move up from November's lows is very very low volume on the index. And yeah, I guess you can kind of see that here. So we got, S&P moving up very sharply on declining leverage. Some of that's, buying in the underlying, but some of that's probably not a good signal. I think the underperformance of NQ here might also be something to note. Bitcoin down today. As far as up volume goes, looks like not as much as yesterday. So a little bit less of a bullish push. And then on the technical side, still breaking out from finding support on the retest of the trend. Yeah, third day in a row, the slightly higher close, I believe. Yesterday's close was 49, today 57. Okay, 57.13. Yeah, I guess so. Um, so higher low, lower, higher high. Still maintaining a trend, but it's weak. I mean, there's obviously not a lot of range on any of these. And this could still fail back to the trend, as we still haven't broken above the 60 or 68 and 69 level, which would give us confirmation of our next leg up in the reversal from back in October's drop. So I guess we'll keep watching for that. In the meantime, the failure point for this is probably just back below the trend line, like under 6,800 maybe. We could confirm that, or at least signal the failure, but I would say I wouldn't be real bearish unless we lost like 67, 64. So nothing really of note here. Getting back above 68.82 and 69, those are the next two levels to the upside. That would confirm the bullish trend, retest of the all-time high or push to new highs into the end of the year. Remember, December end of month is probably where, because of tax loss harvesting and everything like that, can be where cash demand is really the highest. And if the Fed doesn't do anything at the meeting to fix liquidity on the front end, meaning they continue to just roll over additional balance sheet gains but don't move into like distinct quantitative easing, because we moved out of tightening sort of into kind of just a neutral balance sheet stage. Obviously, that's putting a lot of pressure on the front end because the Fed's not sopping up all those bills that no one wants. Um, and so, because of that, if the Fed doesn't move to QE a little bit sooner than planned, I think we're going to start to see some actual liquidity problems on the front end. Like right now, it's bad. They have to sell risk assets. We've seen BTC and indexes both decline due to that. But if that persists for longer and into deeper treasury issuance in December, January, it's gonna be a problem. So chop outside of FOMC, if not data. I don't know if there's any. I mean, tomorrow's data could break like the local trend, but I would say we probably stay between 67, 64 and 68, 82 into FOMC next week. BoJ could contribute to liquidity issues as well. Yeah, so I mean, if the Fed were to cut, and the BoJ were to cut also, all that leverage that's packed into the top end of the carry would have to go somewhere. Or the BoJ were to hike and the Fed were to cut. All that leverage has got to go somewhere. And it's very likely that a fairly significant amount of U.S. treasuries would be sold in order to chase domestic assets, because balance sheets for people holding fixed income in Japan, like major insurance companies, banks, huge mega corporations, all of them, are sitting on piles of foreign bonds, and now all of a sudden the yields right there at home are far more attractive. And if they're carrying, a negative yields on their positions outside of the country, it's going to be beneficial to reshore all that money. And if they reshore all that money, they're going to sell. They're going to sell their foreign bonds, which could, tremendously spike U.S. treasuries, especially if they sell, the majority of the ones they hold are UST. So yeah, they could, especially in the wake of a Fed cut. So if the I mean, the idea generally is like if the Fed cuts, the BoJ doesn't have to do anything, but if the Fed doesn't, then they may have to react. But it's definitely a big systemic risk. So these two rate decisions coming next week and then the following are going to be very important. Anyway, that's it for today. Thank you guys for tuning in. I will see you bright and early tomorrow. Well,